Good afternoon, everybody, and welcome to today's webinar. Welcome to another episode of UBO Tax Webinar Series. We are delighted to have you with us today. My name is Tochukwu Wampo, and I am an associate in the tax practice group at Udodoma and Belo-Osagie, and I'll be moderating today's session. This webinar is organized by the tax practice group here at UBO. Our tax team has extensive experience advising local and multinational clients on complex Nigeria and cross-border tax matters. We are also consistently recognized for our tax expertise by leading international directories, including Chambers and Partners and International Tax Review. And as we all know, Nigeria's recent tax reforms represent one of the most significant developments in the country's tax landscape in recent years. And in response to these changes, the UBO tax team launched this webinar series to highlight key reforms and their implications for taxpayers. So today's session, which is focused on understanding capital gains tax under Nigeria's new tax framework, we will explore some of the key changes introduced by the reforms, the various tax legislation, and the scope of taxable gains, available exemptions and reliefs, and the practical implications for individuals and businesses. The session will run approximately for 45 minutes, and today's presentation will be delivered by my colleague, Solomon Adeboyo, who is also a tax associate here at Udodoma and Belo-Osagie. And after the presentation, we'll take questions and provide answers. While Solomon is delivering his presentation, you may submit your questions at any time using the chat box, and we'll respond to the questions at the end of the session. On that note, I will now hand over to Solomon to begin the session. Solomon, over to you. Solomon, you're muted.
Okay, thank you very much, Tochukwu, for the introduction, and thank you everyone for joining this session. As Tochukwu has mentioned, this is organized by the tax team at Udodoma and Belo-Osagie, and we have been looking at the tax reform that started last year and which kicked off January 1, 2026. And this afternoon, we'll be looking at capital gains tax. As you will agree with me that, so this afternoon, we are looking at capital gains tax. So understanding capital gains tax under the new tax framework. And the new tax framework that we're talking about is the Nigerian Tax Act, the Nigeria Tax Administration Act, and the other two laws that were enacted last year, June, but they took effect January 1st, 2026. And the laws had remarkable effects on capital gains tax. And the first thing that we should note here is that the Nigerian Tax Act, which I will be referring to as the NTA henceforth, repealed the Capital Gains Tax Act. So previously, what we had was the Capital Gains Tax Act, the Value Added Tax Act, the Company Income Tax Act, and various other laws. But with effect from 1st January 2026, all these laws were repealed, and we now have a consolidated law known as the Nigerian Tax Act that governs every of this law. So by implication, the Capital Gains Tax Act was also repealed, and which means that capital gains is now governed by the Nigerian Tax Act. So in today's episode, we'll be looking at chargeable gains, we'll be looking at the rate of capital gains, because previously capital gains was at 10%, but now the rate has changed, so we'll be looking at the new rates. And we're also going to be looking at the specific rules for digital assets. We'll be looking at the grandfathering provisions in the public notice issued by the Presidential Fiscal Policy, and then indirect transfer. So, simply put, capital gains tax is the tax that is imposed on gains realized from the disposal of chargeable assets in Nigeria. So, whenever a taxable person disposes of a chargeable asset, the gain that you make is what we call chargeable gains or capital gains. And then the tax imposed on that gain is what we call capital gains tax. For instance, you sell your car or you sell an asset. We are still going to look at the chargeable asset, but just to bring it home, you sell your car, you sell your building, or you sell any other capital assets. The gain that you make on that disposal is what is called capital gains, and the tax that is levied on that gain is what is called capital gains tax. So capital gains tax is the tax that is levied on gains that accrue from the disposal of chargeable assets. So the next question is, what is chargeable assets? So chargeable assets means any form of asset. So that means that it is quite wide. Any form of assets, shares, options, rights, digital assets, and incorporated property generally. And you will see that from the slide, I actually underlined shares and digital assets. And the reason being that prior to 2021, there was no capital gain tax on shares. So that's why at that time, share disposal or share transfer, it was more favored than asset transfer because there was no capital gains on shares. But the Finance Act 2021 introduced a change and now subject gains accruing on disposal of shares to capital gains tax. So shares also form part of chargeable assets, and we also see digital assets. So it was Finance 2023, because prior to that, it was not clear whether digital assets forms part of chargeable assets. So you talk about your crypto, talk about your blockchain. So as at then, the law was not clear whether the disposal of these assets would give rise to capital gains and capital gains tax. So, but the Finance Act 2023 brought digital assets under the umbrella of chargeable assets, and the NTA has also recognized it. But so we see one thing that the NTA has done is not just to state that digital assets are chargeable assets. It has also provided a definition and some other conditions related to digital assets. We are going to see that. So part of chargeable assets that we also have any currency other than Nigerian currency. We have any form of property created by the person disposing of it or coming to be owned without being acquired. So these are chargeable assets. But as we see from that A, any form of asset. So any form of asset whatsoever that we are disposing, provided it is not exempted, that particular asset forms part of chargeable assets. Then we'll be looking at digital assets. Because I mentioned when I was discussing chargeable assets, that digital assets it is no longer a debate. So the law is quite clear on this, that digital assets are now subject to capital gains tax. But what was not clear before was the definition of digital assets. Because people could argue that, okay, this is not a digital asset, this is a digital asset. So what the NCA has done is to define digital assets. So with this definition now, it's now clear what kind of assets constitute digital assets. So digital assets is defined by the NCA as a digital representation of value that can be digitally exchanged, including but not limited to. And if you pick this definition one after the other, say digital representation. So what we are looking at is something that is digital, and then it is of value. Right? It is of value. So there is value that can be exchanged for that digital representation, and it can be digitally exchanged, can be digitally transferred. And as the law said, including but not limited. So the framework is actually very wide. Crypto is covered, utility token is covered, blockchains are covered, NFTs are covered. So whenever an individual disposes any of these digital assets and gains are made, such gains are subject to capital gains tax. Now, it should be noted there is one important thing that the NCA has also introduced, which is the fact that losses that you incur on your digital or virtual assets can only be offset against profits from the same line of business. So, for instance, if a company is into manufacturing and the company also has some digital assets, so if the company incurs losses from those digital assets, it cannot offset it against profits from the manufacturing business. So we can only offset those losses from the line of business, from that digital line of business, basically. So that should be looked for the purpose of tax planning. So this is like a reference rule to ensure that you can only offset your profits relating to digital assets from that same line of business. So the next thing that we're talking about is who are chargeable to CGT? Who are those that should pay CGT? Now, both resident and non-resident entities are liable to CGT in Nigeria. And when I say resident, I mean entities that are incorporated in Nigeria or in Nigerian residents. Although the NTA have now expanded definition of residents to also mean companies with place of effective management in Nigeria and some other. So those are residents, and non-resident entities are foreign entities, companies that are incorporated outside Nigeria. So whether you are incorporated in Nigeria, you are a Nigerian citizen or not, you are liable to CGT. Just that the rules are quite different. So for resident entities, for Nigerian entities, they are liable to capital gains tax on their worldwide disposals. What this means is that if a Nigerian entity disposes of its shares or any other assets in Sweden, in United Kingdom, in Australia, they are liable to pay CGT in Nigeria. That's what we mean by worldwide disposal. So no matter where the disposal is made, no matter where the Nigerian entity is disposing its assets, it is liable to capital gains tax in Nigeria. But for non-resident entities, they are only liable to capital gains tax in Nigeria under three conditions, or only if they satisfy three conditions. And the first one is if that gains relate to a trade, business, profession, or vocation that is carried on by that non-resident person in Nigeria, or if the gains relate to an asset located in Nigeria, or the gains relate to any asset deemed to be located in Nigeria. Now, that sub-C, that paragraph C, is going to be very important when we are discussing indirect transfer, because not only are they liable to gains on assets located in Nigeria, so even where the assets are deemed to be located, so the key word here is deemed to be located. So the assets are not located, but they are deemed to be located. So the question is, where is an asset deemed to be located? So we look at this when we are discussing indirect transfer. But for this, what we want to understand is that non-resident entities, foreign companies, they are also liable to capital gains tax in Nigeria, where the gains relates to any business or trade that they are carrying on in Nigeria, or any assets located in Nigeria, or where the assets is deemed to be located in Nigeria. So the next thing we'll be looking at is the rate. What is the rate for capital gains tax? So previously, capital gains tax was levied at 10%, a flat rate of 10%. So no matter the gain that you have made, you are liable to CGT as 10%. That was the position before 1st January 2026. But the NTA has now brought a significant reform to this by aligning the CGT framework with company income tax or personal income tax framework. So what that means is that your gain that you have made from CGT is going to be treated as ordinary income, and it will be taxed alongside your other income. So for instance, if a company has disposed of an asset and the company has made chargeable gains, so that gain will be added to the company's income to determine its company income tax. And if it is an individual, the gain will be added to the personal income of that individual for the year to determine the personal income tax payable. And as you know, that for company, the rate is between 0% and 30%, depending on the classification of the company. Before now, or under the old framework, companies are divided into small company, medium company, and large companies. But under the NCA, companies are now divided into small companies and large companies. So small companies are companies with turnover of less than 100 million and whose net assets does not exceed 250 million. For those companies, their CIT rate is 0%. So even if those companies made chargeable gains and you add those gains to their income, if it is still less than 100 million, then the CGT rate will be 0. I don't know if that's clear. If you have any question like people noted earlier, you can always drop it in the Q&A or the chat box, and we attend to it at the end of the session. So, but for large companies, those are companies with turnover of above 100 million. They are liable to tax at 30%. So their CGT will be added to the income tax and then levied to company income tax as 30%. Whereas for individuals, the rate is 0%, where the annual income is less than 800,000, or they will now have a graduated rate of 15% to 25%, depending on the income. Like the law has stated, 0% for the first 800, 15% for the next 2.2 million, then like that until we reach the apex, which is above 50 million, which is taxed at 25%. So depending on the chargeable gains for annual income of the individual, the rate will be between 0% and 25%. So that's it. So there's no longer a flat or a fixed rate of 10% like we had in the old regime. Now, under this new regime, it depends on the classification. For small company, 0%. For large company, 30%. Individuals between 15% to 25%, depending on that individual's income. So on presidential fiscal policies public notice. So last December, because there were a lot of uproars and a lot of concerns about this new CGT framework, because the capital markets, there were a lot of concerns about this new CGT framework from the capital market participants. And because of this, the Presidential Fiscal Policy and Tax Reform Committee, led then by this current Minister of Finance, Mr. Tawi Udele, they came up with this notice in December last year. And the notice introduced a transitional or a grandfathering rule for gains that accrue before 1st of January 2026. So I'm going to be discussing 2 or 3 things that can be picked from that notice. But what we should note is that that notice remains a notice. It is yet to be adopted by the NRS, and it's yet to be to become part of our laws. So it is still a notice. NRS, they are yet to adopt it, and it is yet to become part of our law. So whatever we are saying on it, we should just note that it is still a notice. So one thing that the notice stated was that any increase in value of shares up to 31st of December will continue to be treated under the old law. So depending on when the asset is disposed, the gains should be treated according to the law that applies at the time of disposal. So let me give us an instance. So on disposal that happens after 1st of January 2026, that gain will be split into 2. So we have gains that accrue before 31st of December, and we have gains that accrue from 1st January. So gains that accrue before 31st of December, because as at then, the law applicable was the Capital Gains Tax Act. And under the Capital Gains Tax Act, the CGT rate was 10%. So for gains that have accrued before 31st December 2025, the CGT rate applicable will be 10%. Whereas for gains that accrue from 1st of January 2026, the CGT rate will be 30%. So what they have done is to kind of placate the concerns that the capital market participants had as at then, because there were concerns around the fact that many gains are accrued before 1st January. So why then should the 30% rate be applicable to those gains that are accrued under the old law? And that was why the committee came up with this principle that on gains that have accrued before 1st January 2026, those gains will continue to be taxed as 10%, while post-2025 portion of the gain will be subjected to the new CGT. So let me give us an instance. For instance, if shares were bought as 100 naira in 2024, just an instance, if shares were bought as 100 naira in 2024, and by December 31, 2025, the value of the shares was 200, right? If as at March 2026, the value of the shares is now 300. Remember, you bought the shares at 100 naira. By December 31, the value of the shares was 200. By March 31, the value of the share was 300. If you dispose that share in March, Now, you know that you acquired the share for 100 naira. You are disposing for 300. You have made a gain of 200, right? If you want to go by the current rule, because you have made a gain of 200, we should subject that gain of 200 to 30% CGT. But what the notice is saying is that no, we will not subject the old 200 to 30%. What we do is that as at December, the value of your shares was 200. So that means between that 2024, when you bought that shares, and 2025, the shares you have made a gain of 100 naira. Remember, so that 100 naira will be subjected to CGT as 10%. Then between that January 1 and March, you've also gained extra 100 naira. That extra 100 naira will be subjected to CGT at 30%. So there is a pre-2026 gain that will be subjected to tax at 10%, and then there is a post-2026 gain that will be subjected to tax at 30%. If there is no such grandfathering position, what we'll be having is that the old gain will be subjected to tax at 30%. But what this has done is to split the gain into two: the one under the CGT Act and the one under the NTA. So another thing that the committee noted in the notice is the cost rebasing. So what they've done is that they introduced a tax rebasing mechanism for existing share that you have before 1st January. So for share that you have before 1st January, the cost base, because when you are calculating your capital gains tax, basically capital gains tax is the difference between the base cost, that is the acquisition cost, and disposal proceeds. For instance, if you bought your asset at 100 naira and you are disposing it for 200, your capital gains is the difference between your disposal proceeds of 200 and your acquisition cost or your base cost of 100. So what the committee is saying is that the base cost should be reset to the higher of your actual acquisition cost and the closing market price as at 31st December 2025, the higher. So let me also give us an example to drive home this point. If like the example I gave earlier, in 2024, you bought the shares for 100 naira. As at December 31, the shares are now worth 250, right? In March, you dispose the shares for 350. In determining the CGT rate, we will not use the original 100, because what the law is saying that we are going to reset the cost base to the higher of the actual acquisition cost or the closing market price. Now, which one is higher between the actual acquisition cost of 100 naira and the closing market price of 250? You will agree with me that that's 250. So in determining the capital gains tax, we are going to be looking at the closing market price of 250. So that's what the committee has also come up with. Now, we should note under the note, we see that these rules are yet to be adopted by the NRA. So they are just like recommendations from the committee. They are yet to be adopted and they are yet to be enacted. They do not form part of the current law as it were. So they are just like recommendations by the NRS and by the committee. So we are still waiting for detailed guidelines and regulations by the NRS on this point that I have raised. And lastly, from the committee, they also made mention of realized foreign exchange losses. So for people that are familiar with the forex market, you know that because of the devaluation of naira at some points, many companies recorded foreign exchange losses. And from the basic rule of taxation, we know that only realized foreign exchange losses are allowable for company income tax purposes. But for CGT, under the law, there is no provision for you to deduct foreign exchange losses when computing your capital gains tax. There is no provision for you to deduct your realized foreign exchange losses. But what the committee has done is to state that where you have incurred realized foreign exchange losses that are incidental to the investment, then you should be able to deduct those realized foreign exchange losses when you are computing your capital gains tax. So let me give us an example to drive on these points. The example I was giving earlier, let's assume that in 2024, you invested 1,000 USD. And when you converted this, it gave you 40 million naira. 40 million. So let's say, okay, it gave you 400,000. You invested 1,000 USD, gave you 400,000 naira. USD is 1,000. But when you converted it to naira, you had 400,000. Now in 2026, when you are selling your investment is giving you 800 USD in USD terms, but it's giving you 800,000 naira. Remember, you invested 400,000, but now you are selling for 800,000 naira. Have you made a gain or loss? You made a gain in naira. But in USD, you invested 1,000 USD, but you are getting 800 USD. You have made a loss in USD terms of 200 USD. So if you are only looking at the naira, you have made a gain of 400,000 naira in naira terms. But in USD, you have made losses. So the committee is saying that you should be able to deduct those realized foreign exchange losses. But just to reiterate, like I said earlier, that this is still like a recommendation from the committee. There is not yet, we have not received a response or any guideline or regulation from the NRS on this point. So all hands are on deck, waiting for the NRS to issue detailed guidelines on these points that I have noted. So the next one we look at is exemption. So it is not, remember when I was talking about chargeable assets, I said all assets, right? But then it is also not all assets because some assets have been exempted. So even though you are disposing of the assets and you make gains, those gains will not be chargeable. So the first example that we have is shares. Now, when you dispose your shares and you make gains that are less than, or when the proceeds are less than 150 million, and the chargeable gain is less than 10 million within any 12 consecutive months. Now, under the previous framework, under the CGTRs, what we had was just that where the proceed is less than 100 million, there was no second leg of this 10 million. But the NTA has now introduced this second leg that if you have disposed your shares, but where the proceeds are less than 150 million and the gains is also less than 10 million naira, then there will be no capital gains tax. But where it exceeds, then there will be capital gains tax on that excess. So the next one is where you fully reinvest the proceeds in the shares of a Nigerian company within the same assessment year. So for instance, you dispose of your shares in August, you gained maybe 100 million, and you reinvest that proceed, you collected 100 million rather, and you reinvest that 100 million in the shares of another Nigerian company, there will be no CGT on that proceed. So another one is compulsory acquisition of land. So where the government compulsorily acquire the land and they pay compensation to that person, that compensation is not chargeable. There is no CGT on that compensation. But note that for this to apply, the individual or the person must not have advertised or make plans to sell the land to the government. The land must actually be compulsorily acquired by the government. So another exemption that we have is compensation for injury to person or loss of office. So where a person is injured and then compensation is paid, or the person loses his office and compensation is paid, that is less than 50 million naira. Where it is less than 50 million, that particular compensation will not be subject to CGT. But where it exceeds 50 million, then any portion above that 50 million will be subject to capital gains tax. Then, where there's a disposal of private motor vehicles, so if you dispose of your private motor vehicles and you make gains, there is no CGT on that. But there's a caveat, it must not be more than 2. So where you dispose more than 2 and you are making gains, or gain that you made on other vehicles above that 2, will be subjected to CGT. So the exemption only applies to maximum of 2 vehicles per year. So once you dispose more than 2 vehicles and you make gains, there will be CGT on that gains. Then you receive a gift and you also dispose of that gift, then there is no CGT on that. When you dispose of pension fund and assets, there is no CGT on that. Then gains from investments in a label startup, provided that that asset has been held in Nigeria for a minimum of 24 months, there is no CGT on that. So a label startup is defined under the Nigerian Startup Act. So when you look at the Act defines what constitutes as label startup. So when you are disposing your investments in a label startup, there is no CGT on that. I think this is an advantage that many investors have benefited from. So determination of gains. How then do we determine gains? This is talking about determination of gains. How we determine capital gains. And okay, let me first drive on this point, then I'll talk on what I wanted to say. To determine your CGT, prior to now, there was no condition of considering capital allowance, but the NTA has kind of changed the rule to introduce capital allowance consideration. So where capital allowance has been claimed on that asset, then only the tax written down value of that asset will be deducted from the disposal proceeds to determine capital gains tax. So what do you mean by tax written down value? So when you get your assets, the tax man will allow you to claim capital allowance, which means that every year you are claiming capital allowance, then the tax written down value is the cost of that asset minus the capital allowance that you have enjoyed to date. That will give you the tax written down value. So when you are disposing your assets and we want to compute capital gains tax, we are going to be looking at the difference between the proceeds that is accruing to you on the disposal of that asset and the tax written down value of that asset. That is where you have claimed capital allowance on that asset. But where an entity has not claimed capital allowance on the asset, then the chargeable gain is calculated by deducting the acquisition cost from the disposal proceeds to determine capital gains tax. So for instance, if the acquisition cost was 200 and disposal proceeds is 400, so 400 minus 200 will give you 200 capital gains tax. But if the entity has claimed capital allowance on the asset, so you acquired the asset for 200, but you have claimed capital allowance and the tax written down value of the asset is now 80. So you can only deduct that tax written down value from the disposal proceeds to determine your CGT. Then, what are the allowable deductions? Because the law allows you to deduct some expenses that you have incurred. Because in the course of either acquiring or disposing the assets, you must have incurred some costs. So any incidental cost that you have incurred wholly and exclusively for the purpose of disposing the chargeable assets is deductible from the disposal proceeds. Now remember that, or you can see, you notice what we have is wholly and exclusively. Under the old framework, what we had was what we know popularly as rent test, wholly, reasonably, exclusively, and necessarily incurred. But under the new framework, under the NTA, what we have is wholly and exclusively. So reasonably and necessarily has been removed. So any cost that you have incurred must satisfy these two tests before you can deduct it from the disposal proceeds in determining the chargeable gain. So the cost must have been wholly and exclusively incurred before you can deduct it. And so if you deduct any costs that were not wholly and exclusively incurred, the tax authority, they might disallow those expenses. Now, before talking about the administration of capital gains tax, who do you pay your capital gains tax to? For resident individuals, you and I, we pay our CGT to the relevant state internal revenue service of your or our state of residence. So it depends on where you are resident. If you are resident in Lagos, you have to pay your CBT to the Lagos State Internal Revenue Service. If you are resident in Oyo State, pay to the Oyo State Internal Revenue Service. Residents in Ogun State. So it depends on where the individual is resident. If you are resident in a particular state, you have to pay the CGT to that particular state. For companies, companies file their returns and remit the applicable CGT to the Nigeria Revenue Service, that we formerly know as the FIRS, Federal Inland Revenue Service, but now the Nigeria Revenue Service. So for companies, they have to file their returns and remit the CGT to the NRS. Why for non-residents? Remember I mentioned earlier that non-residents are also liable to capital gains tax. So they are to pay their own capital gains tax to the NRS. And on filing returns, previously, capital gains tax returns are filed biannually. So you file one by June, you file another one by December. But now, because the CGT framework has been aligned with the CIT framework, we no longer have the biannual filing. So filing will now be done alongside your company income tax annually. And if you will recall that for last year, the company income tax for companies with December year end, the deadline for filing will be 30th of June. So filings are to be done within 6 months after the end of the financial year end. For companies, filings are to be done within 6 months after the end of their financial year end. So for most companies that have their year end as December, the filing should be done on or before 30th of June of this year. While for individuals, filings are to be done on or before the 31st of March of the following year. So for last year, the filing deadline was 31st of March this year. So the filing is 31st of March this year, and that's how it is annually. So that is about administration of capital gains tax. Then the last thing I will be discussing on CGT is on indirect offshore transfers. And this has generated a lot of buzz, it has generated a lot of concerns, arguments, analysis. Because before now, most companies they try to plan, they try to manage their affairs by ensuring that maybe they have intermediate companies, SPV, and because of that, they are able to kind of manage their tax, their CGT exposure in Nigeria, because the shares are actually not being disposed of directly. So, but what the NTA has done is to block some of these leakages with the introduction of indirect offshore transfer. So what that means is that, and okay, let me lay this basis. When I was talking about non-resident person, I mentioned that they are liable to CGT in Nigeria where the assets are deemed to be located in Nigeria. Section 17 sub 2 of the NTA, where the assets are deemed to be located. So this is where that particular phrase, deemed to be located, is relevant, because when an entity is disposing of shares, a non-resident entity is disposing of the shares in another non-resident entity that has shares in the Nigerian entity. So let me give us an example. Company A is located in United Kingdom. It is disposing its shares in company B that is domiciled in, let's say, Mauritius. Company B has shares in Nigerian company. Now, when company A, the UK company, is disposing of its shares in Mauritius, it has nothing to do with Nigeria, right? Because company A is not shareholder in company C. Company A is only a shareholder in company B. So before the NTA, any gain that company A is making from the disposal of the shares in company B, nothing concerns Nigeria with that gain. But the NTA has now brought in this indirect offshore transfer to tax such disposal. That even when company A is disposing its share in company B, if company B derives substantial value from company C, then that disposal of shares in company B will attract Nigerian CBC. It's kind of complex, and people have been asking questions. Why is Nigeria introducing this particular rule? So it is in line with the global move, the OECD, the Pillar 2 recommendation, and also Nigeria is just trying to align itself with international trend. Because if you look at most countries, they have also introduced this particular rule into their own domestic law. So what this rule simply put is that where there is an offshore disposal of shares by a non-resident entity that will result in a change in the ownership structure or group membership of a Nigerian company or of ownership or title in any assets in Nigeria, then CGT will be triggered. And then assets or shares are deemed to be located in Nigeria if in the 365 days before the disposal, more than 50% of the value of the shares or assets are derived directly or indirectly in Nigeria. So let me give us the example I gave earlier for that company B. So if that company B has assets and the only assets of that company B is in Nigeria, you get that? If the only assets of that company B is in Nigeria and company A is disposing of the shares in company B, what Nigeria is saying is that, look, this company B, all of your assets in Nigeria, you are deriving substantial value from Nigeria. Therefore, any gain that accrue to company A from the disposal of its shares in your company, we are going to levy CGT on it. Again, let me give us an example. If company B has assets in Nigeria, in Ghana, in Mali, in South Africa, and that's like 4 countries. If we look at the value of assets in Nigeria, if it is less than 50%, let's assume that the value that is derived from Nigeria is just 40%, 30 from Ghana, 30 from maybe 30 from Mali, and 30 from South Africa. That means the value that is derived from Nigeria is less than 50%. This particular rule will not be triggered. So what they are looking at is that intermediate entity, that SPV, is it deriving substantial values from Nigeria? If the SPV is deriving substantial values from Nigeria, then it will trigger this indirect offshore transfer. But still, there are some considerations or there are some issues that are still not clear, and we still await details because we've received many requests from some offshore entities requiring clarifications on some of these modalities. For instance, how will the gain be calculated? Because the share is not that of a Nigerian entity, the disposal is done offshore. How do we determine the base cost? How do we determine the gain? The modality is not spelled out in the law. Another thing is that who is responsible for filing and paying the tax? Because company A is a UK entity. Company B is, like I said, is a Mauritius entity. Company C is a Nigerian entity. If company A does not pay, can the NRS go after company A, or will they go after company B, or will they go after the Nigerian entity? So the modality for enforcement is also not that clear. Ordinarily, the seller should be responsible for the payment, but where the seller that is offshore does not pay the tax, who is liable? Can the NRS go after the Nigerian subsidiary? Again, how do we determine the tax base? Are we going to tax the entire gain or only the portion attributable to Nigeria? Then, how do we also calculate this 50% threshold? These are all questions that are being asked and that currently we do not have answers to under the current framework. But we expect, this is already June, we expect that detailed guidelines, detailed regulations will be issued by the NRS that will provide clarity on some of these issues. But the summary is that offshore transfers are no longer exempted from CGT in Nigeria. Once the threshold are met, they are liable to capital gains tax in Nigeria. So with that, I have come to the end of my presentation on capital gains tax under Nigerian new framework. I want to appreciate everyone for your patience, and I will be handing over to Tochukwu to coordinate the Q&A, if any. Thank you, Tochukwu.
Thank you, Solomon. Sorry. Thank you, Solomon, for such an insightful presentation. Today's session has provided valuable guidance on the capital gains tax regime under Nigeria's new tax laws, including the taxation of chargeable gains, available exemptions and reliefs, and practical considerations for taxpayers. We will now move over to Q&A session. If you have questions, please use the chat box or the Q&A box, and we'll read the questions and provide responses. I believe the session has been very insightful, and I'm sure we have many, many questions to ask. So I will just wait for a few minutes for participants to drop questions in the chat box for our speaker's response. So someone says, thank you, Solomon. Very, very comprehensive summary of the new CGT rules. And I completely agree that that was such a comprehensive summary. And I also like the fact that we didn't just understand the laws, we also saw the practical considerations of the new rules and how they apply to taxpayers' businesses. So thank you, Solomon, once again. And we are looking forward to more comments and questions for our response.
We sometimes give them like the ones maybe raise their hands to speak or it's just strictly you should drop it, drop comment. Okay.
I think there's a question in the Q&A session. I'm not sure why it's not popping up on my screen, but please put it in the chat box so that it's clear to everybody.
Okay, so I think I can see the question from here.
Okay, you can see. Okay, I think you can go ahead to.
In relation to indirect offshore transfer under the NTA, who do you anticipate the NRS regard as the taxpayer, where both the seller and purchaser are non-residents? So ordinarily, the taxpayer should be the seller because that's the person making the chargeable gains. But where the seller is non-resident, the purchaser is non-resident, the enforcement becomes problematic. But again, you should know that there is this exchange of information that has become, that become more popular these days between tax authorities. So they might want to use that to perhaps reach out to the tax authority of the country where the taxpayer is a resident, or there's also not a new provision, but there's a provision under the NTA called power of substitution. So what that means is that where the non-resident entity, maybe the seller now, has some fund or asset or money with the Nigerian entity, the NRS may actually appoint the Nigerian entity as to substitute the Nigerian entity for that seller and ask the Nigerian entity to pay the tax. But currently, there is no clear guideline, there is no clear modality on how the NRS intend to enforce this provision. But I'm sure they are also considering this, and when the guidelines or regulations come, then we would have clear information on how they intend to enforce. But they could explore the exchange of information rule. They could also explore this power of substitution that we have under the NTA and every other means. But ordinarily, the seller should be the taxpayer.
Thank you, Solomon. I'm sure that is very, very clear. And we have another question. I will just read it. It says, thanks for an insightful presentation. You mentioned that CGT is going to be taking on worldwide assets. What happens in a situation where CGT has been paid offshore to a foreign regulator? Would that not create a double taxation situation for the seller?
Okay, so thank you very much for that. So that's where the double taxation agreement comes into place. The rule is the rule. For Nigerian residents, you are liable to CGT on your worldwide disposal. But where you have disposed the assets and paid tax in a resident in a jurisdiction that has a double taxation agreement with Nigeria, then you are able to enjoy relief in Nigeria for that tax that you have paid. You are able to enjoy relief. Again, if there is no double taxation agreement, there is a new provision in the law that allows for unilateral relief. So even where there is no double taxation relief in that country, you might also want to explore the unilateral relief provisions in the law to enjoy relief for those tax that you have paid in other jurisdictions. I hope that answered the question.
Yes, I'm sure it does. Thank you, Solomon. Thank you once again for your valuable insights. And to all participants, thank you for joining us today.